Good morning, everyone. As it's the first talk of the day, and Fin comes before tech, it's going to mostly be about Fin, making money, which is probably, you'll find, something that's dear to the heart of most people in commerce. We'll be discussing over the next couple of days around the compliance requirements of PSD2, and we'll be talking about some of the evolving technology and techniques. But, we talk about open banking synonymously with PSD2, so we probably need to talk about banking and how banking traditionally has made money. Because we talk about an ecosystem, and this ecosystem should be superior in terms of driving the industry and serving customers. But if it's to be superior, it has to be more effective at making money. And that's a pretty important thing to talk through. I have an obligatory slide here on how PSD2 is creating an obligation on major European banks to provide APIs. If you have too much time in your hands, Article 66 of PSD2 talks about how there doesn't have to be a contractual relationship between these new overlay PISPs and AISPs and the underlying account servicing PSBs, who are effectively, in most European countries, the leading banks. And no contractual relationship means a contract has offer, acceptance, and consideration, so no consideration. Okay, so there's a gamut of reference material on that. I think graphically this is what it means, that stepping stones are being created to enter the financial services industry. I think Bill Gates said in the 1980s that he could replace banking or banks with a couple of lines of code, but he never did, and possibly because with these fantastic rights to take deposits and give loans come very significant obligations around consumer protection and prudence. So he never did. And I suppose for many major service providers, historically, retail and commercial banking looked like a Mount Everest of red tape and stuff that they weren't any good at. So in 2009 with PSD1, we had the first stepping stone where formalised legal entities in Europe that pretty much did everything bar the loans and deposits. And now in PSD2, even more sympathetic stepping stones get into the industry for either a smaller scale financial services specialist or a high scale non-financial services specialist. But I suppose it's important to call out one thing in relation to this, is that undoubtedly competition authorities would like to see retail and commercial banking markets be less consolidated. Not healthy to have 80% of the market carved up between 4 or 5 banks in most European member states. And they may be glad to see many challenger banks emerging. But if you were to ask regulators on the prudential side of central banks how many big balance sheets would they like to see doing loans and deposits, they mightn't say 4 or 5, but they probably wouldn't say 15. So maybe they might want 7 or 8. Okay, so it's a reasonable supposition that regulators who want to assess economic risk and monetary policy through bank balance sheets don't want too many of them. They want more, but they don't want too many of them. And to do that, to be a full-service, high-scale, sexually diversified credit institution is very capital-intensive. So in that context, stepping stones come into the market, and it can either lead more people or more investors to the top of the Mount Everest, or it actually might cause more players to stay lower down on the lesser, not lesser, but the smaller scoped licenses, some rights, some obligations. But why would you enter the industry? And I suppose it's a key assumption of, do we think the advent of fintech and open data ecosystems is going to change the fundamental economics of how the industry gets paid? In whatever way businesses and consumers consume the services that the industry offers. And I'm generalizing here because in some high-scale credit institutions it's 2/3, 1/3. But in general, 3/4 of the revenues that come in these industries comes from net interest margin. Okay, so it's balance sheet driven revenues. Okay, so a lot of the talk around how customers are going to interface beautifully through new third-party apps and services with their bank account, that's great. But if you're going to stay in that space, you want to be doing it on a very, very high scale, because actually, traditionally, only 1/4 of the revenues come in that space. Okay, so either be doing it on a very high scale or find some use for the data or some value from the data that will drive a broader proposition. So this is a pretty fundamental thing. And I can tell you on my travels across both fintechs, some in very, very early stage, there are people who think they're going to enter this industry who don't actually know how it makes money, which is probably nothing, and the fact that there's a venture capitalist willing to give them money is quite remarkable. Okay, so, there's a key assumption we can make about the role of these balance sheets. Why does the market reward credit institutions for taking deposits and giving loans? Well, they actually carry out absolutely two crucial functions. First of all, they attract private investors who put up a buffer of equity, which is there to be a buffer between the valuation of the loans collapsing or a sudden increase in increase in the cost of funds. And they also provide a maturity transformation process where they can lend out money for 2 years, but in theory, every depositor can have their money back now. Okay, and it's a reasonable supposition that these value adds will remain whatever way we deliver software and services in the future. Okay, and prudential regulators won't want 20 of these balance sheets. They want more than they have at the moment, but they won't want 20 or 30 in a member state because they may not be stable and they may not be sectorally diversified. So that's where 3/4 of the money comes from. There's a correlation. They take in deposit at X and they lend out at 3X. And that's pretty much how the thing works. Lots of ancillary services at the side, but that's how the thing works. Okay, so it's a reasonable assumption that's a fundamental that won't change, even though the people who are benefiting from this might change and the names on the doors might change over time, but these balance sheets are absolutely crucial lubricants in a modern economy between those who have money who want to place it for a long term but get access to it, and basically mature households and mature businesses recycle capital back through banks, through credit institutions, into immature households and immature businesses. So almost certainly not going to go away. But can we see some fundamentals that are changing? Okay, well, there's no doubt that exposed APIs will make partnering far more efficient. So strategic alliances were horrible, joint ventures were horrible. You'd get on aeroplanes, travel around the European Union, find the right people, speculate about how much money you could make together, get lawyers involved, potentially end up with something customized that you couldn't scale, and then the initial sharing of interests came under immediate stress the minute you hit the market. So strategic alliances are tough. You invest a lot in them, and a lot of the time they don't deliver what they promise. Whereas APIs, you can look at your inherent capacities and your inherent data and your processes, and through published APIs, put out samples of more significant processes that will attract partners that you expect and maybe partners you don't expect. Okay, so significantly more efficient. You don't have to show your full hand of cards. You can show some of your capabilities and hold others back for more commercially advantageous situations. So potentially a fundamental change in capacity for business partnering. And there's no doubt that PSD2 is having an impact in terms of exposed APIs, because PSD2 will increase the variety of business models and increase innovation. So one of the big discussions with clients at the moment is trying to figure out who will the PISPs be and who will the AISPs be? Who's going to turn up on the first day? Who's going to wait and see? And it's difficult. It's difficult. It's difficult to see how many will appear on the first day and attempt a pan-European service. Okay, because they're assuming then that the whole environment is pristine and perfect to operate on the first day. But PISPs are interesting. If you are purely involved in the acquiring side of cards, which is a four-party model and you're one of the four parties, the PSD2 model for payments doesn't include you. So that's something that should concentrate minds. And it is concentrating minds. So there's a lot of companies out there that are 100% path dependent on the card schemes ultimately for their revenues. And it's a sobering discussion when you say, listen, if only 10% of volume moves from card schemes into this new mechanism, there could be a 30% reduction in gross revenues from the card schemes, because loads of people who might be able to move traffic from the card schemes will immediately look for a discount. So two rails where there was one before. So in the context of the quarter of industry profitability that comes from daily transactions and the profitability that comes from unsecured credit on cards, that's a big issue. AISPs, you can let your imagination run wild, but there's no doubt that there's vast amounts of cost invested out there in reconciling bank ledgers and other people's ledgers. And this could be done far more efficiently through exposed APIs. And there's a lot of possibilities we can see in that space. In terms of making money, traditionally credit institutions have monolithic channels, digital channels, encapsulating many, many services. Great environment for upselling, but the new buyers now are demanding modular, multi-brand environments. very, very clear in the SME space. If you look at the Xero platform for cloud accountancy and the add-ons that are available there, you know, there's a generic set of services that are available for a small business, and if they're a retail business, they go one direction, and if they're an exporting business, they go another direction and buy different add-ons. And the idea of coming to your bank, especially when banking services could be available to your accounting package post PSD2, and signing up for 20 services that you won't use for the next 5 years because they're bundled into the channel, is not matching how the market is evolving. So the impact of the API economy on small business looks quite clear, and the fact that they pay for their banking means they're quite attractive. Similarly, modular purchasing by consumers in the API economy, we could see all sorts of stuff happening. We could see merchants who want to try and push traffic away from expensive card schemes into PSD2, throwing loyalty points into the process to try and get the traffic to change. So again, more modular purchasing, but maybe not as impactful on consumers because younger consumers who want the latest kit don't have much money. And they're far less financially sophisticated than businesses. So channel strategy for the traditional banks was something about, will we try and deliver services through a branch, a kiosk, an ATM, a relationship manager, whatever. But actually it was all own brand, own manufactured, own channel, all proprietary, closed banking, for the want of a better description. And now channel management is becoming a far more dynamic and sophisticated challenge. There will be, in this open environment, there'll be pure substitutes. So credit institution versus credit institution, payment specialist versus payment specialist. There'll be part substitutes, partial overlays. They'll compete on credit, but they won't compete on payments. They'll compete on payments, but they won't compete on credit. And there'll be complements, which is quite interesting. So traditionally, everyone that was attempting to serve retail and commercial customers used a payment account as a wedge product. And some of the new challenger banks have started on this path of, we'll use payment account as a wedge product and we'll upsell from this. Now, the promise of PSD2 is that you don't have to offer a payment account as a wedge product. You can overlay on top of other participants' payment accounts, and from that overlay position, attempt an upsell. So a far more dynamic and sophisticated channel management strategy, and a cultural challenge for traditional financial institutions who are programmed to think own brand. If the customer can't see my brand, I'm losing something. But in fact, if your volumes are growing, your business is growing, your profits are growing, how much do you care? You know, so a new challenge. This thing is. This is frozen on me here. Gone to here, but not here.
There you go.
There we go. Thank you. Okay. So I suppose this is a visual analogy to try and represent a change where the industry traditionally has closed banking and it's been a hub and spoke distribution strategy. Everything out through proprietary own brand channels. And I suppose at a very crude perceptual level, PSD2 is creating as legal entities for layers of a stack. Okay, so now you're in a stack of services, and crucially, I suppose if you're heavily dependent on the card schemes for revenues, in terms of the bottom layer, what was, in terms of retail commerce in Europe, a one rails market, because when the internet came in the 1990s, there was only one global means of settlement called credit cards for consumers. There'll now be two rails. And even if 10% of volume moves across, it should put big revenue pressure on the card schemes. And now we have a layer of these account servicing traditional banks who are obligated to open up with customer consent onto a new layer above it, who will be AISPs or PISPs. And they could be single businesses, they could be new investors picking out an entire industry vertical and becoming an AISP, PISP for that industry, and mashing in industry-specific services with the generic banking services. Okay, and at the top then, individual communities. And I'll come on to them in a bit more detail because how the layers move up will probably influence the revenue impact on the industry. I talk about technology, but I can't operate it. I'm okay now. Thanks.
I talk about technology and operate it.
Okay, there we go. Okay, so in the context of that, Okay now, thank you. Yeah. I'm not completely helpless. So maybe the traditional banks are now the broad middle, and above that there will be a layer of curated platforms that are attempting to bring banking services along with other services into specific communities. And even above that again, there could be very, very specific communities. And let me explain that in a bit more detail. And as we're in the most urban of environments of a skyscraper, but we're talking about how can we make all the stuff around APIs real and relevant and effectively make more money, or more efficient ways of making money, it's probably important we talk about some proper entrepreneurs called farmers, okay? So you can probably, it's a hazy day, so we probably can't see a farm from here, but traditional banks love farms, okay? They have a well-established quantum of business risk, the risks that they run. The crops don't grow, the animals get sick. They have collateral, they have land, they have machinery, their clients for leasing, they get state subsidies. Okay, there's so many ways that lenders love farmers. Okay, so in the context of this, are we talking about kids in Starbucks with apps and they're switching from bank apps to cooler apps, but they have no money? No, the API economy and API strategy for traditional credit institutions should and will evolve in this direction. So we're now seeing the early advent of cloud-based subscription farm management software, okay, just like every other industry vertical. And some of those are appearing as add-ons to cloud-based accountancy packages, because when you take away the farm, it's a small business, okay, just like a shop or just like an importer. So in that context, it's a small business. And what's actually now appearing in the public cloud with these new applications that interest lenders who drive 3/4 of profitability in banking, well, inside those applications are everything you need to know about whether you should lend this guy money or more money, okay, and what you should charge him for that money, because his collateral is in it, okay. These applications are going to have the farm mapped on Google Maps, cross-referenced to the land registry, okay. Within that, you'll see his animals, his treatments, his performance, his yields, okay. In terms of his filings, the lower level below, which is not sectoral specific, it'll be a curated platform, it'll be Sage 1 accounting software, and in that will be all the data that his accountant needs to see, his auditor needs to see, potentially the Department of Agriculture needs to see. So in the context of that, banks are initially responding to PSD2 as they're being obligated to provide APIs. It's about the provision of APIs, and they're scratching their heads and looking at what premium APIs could I develop if I have to buy this equipment. But actually the API economy in terms of the consumption of APIs holds enormous promise for the industry. And there's a lot of focus on, well, if some other eyeballs gets in front of my payment account, I'm going to lose a lot of money. You know what? The API economy could cut bad debts in banking by 20%, because information opacity about the true trading position of the customer is actually the cause probably of 20% of bad debts. So this is not the only industry vertical we can consider. We can look at shops. Okay, increasingly shops are using cloud-based point-of-sale software. Clover, produced by First Data, is a great example. And in the context of that, it's a vertical, specific, and all of the data in these applications is interoperable into accounting packages, and the accounting packages will be interoperable into banking packages post PSD2. So we can see these layers of a stack, and if you want to see where the industry is going, if you look at the American version of Clover, okay, amongst with all the other buttons that you can see, there's a button that says Get Insights, track the performance of your staff, and there's a button that says Get Capital. Okay, so the Get Capital button can track your credit card receipts and can offer a lump sum advance against a predetermined payback period on your credit card receipts. So in these layers, things that lenders really care about is going to emerge, and in that Get Capital button, or Place Capital in terms of excess revenues, in that Get Capital button is 3/4 of the industry's revenues. Not just a small business thing, lots of data becoming available through APIs. What other segments do bankers care about? As lenders, they care about students. That transitional period when you go from a child with no money to potentially a professional with plenty of money. So they've very much focused on student lending. What can the API economy do for student lending? There's data coming available through public sources on how likely you are to pass your exams, what salary you're likely to get when you finish, what's the pass rate. And in terms of an open banking economy, these loan facilities require guarantors. With an open banking environment, the guarantor can be in one bank and the student can be in another bank, and that can be abstracted out into a shared layer. So these new consent layers will emerge, and they'll emerge on top of the stuff that lenders really care about, which is loans and deposits. Okay, so people who are interested in bringing APIs into the financial services sectors have to follow the money right up in through these curated platforms and right up into the sectoral specific layer, because in that layer is the data about whether the guy is going to pay his loan back or not, whether the person has it potentially deposited or not, because that's where the bulk of the money comes from. So anyone building a business strategy probably has to make one key assumption. Okay, what fundamentals are changing and what fundamentals aren't changing? Okay, definitely two rails coming in EU digital commerce. There will be better insight in the API economy as enterprise applications move into the public cloud on customer borrowing potential, but that will be shared amongst providers. And there's going to be a real increase in competition. I have clients that are monoline credit providers that only provide secured finance, and they are going to move into unsecured finance as well once they can get access to payment account data post PSD2. So rivalry will go up, and crucially, banks' own brand monolithic channels will have a modular alternative. And that's not good news, because potentially mature households and mature people will stick with the bank's own brand stuff, and the new generation will work through overlays, and then there's a migration problem that could have quite a long tail. So high-tech graphics that would put Accenture to shame. If the ecosystem weight is not driving balance sheet growth, none of us are going to make money out of open banking. Okay, so a whole new set of metrics are going to have to emerge, and this is going to be a crucial cultural and organizational problem for mature banks because they don't have any of those metrics. Okay, so bank CEOs have been asking since 1959 how many people borrowed on their credit cards last month. Okay, all of these assumptions and metrics around performance and growth and the world where it is now is absolutely baked into performance management and trickles down through very large, complex organizations. There are no metrics in place to track the commercial opportunities and performance of an open API economy, and that's a huge journey for these traditional credit institutions to travel, and it's important for everybody because there may only be 6 or 7 of them in every key regional market in Europe. So what would a credit institution CEO care about if they were joining us here today? Well, APIs that make my internal and external development more efficient, that's nice. APIs that provide a more modern alternative for my customers to my monolithic channels, yeah, that's pretty nice too. But actually what's a game changer is tell me how this ecosystem will grow my balance sheet faster and better. How can I get fewer bad debts? How can I get more loans into younger companies, younger people? How can I get more dynamic in my deposit gathering? Okay, so in the long run, payments are only seed corn. Daily banking is only a means to an end. You know, I'd let all my own, efforts around branded proprietary digital go if you told me your ecosystem could transform the quality and growth of my balance sheet. So as these metrics come into position, and any vendor that's trying to sell API management software needs to understand that this whole commercial layer needs to be developed as well, and this is not an area that traditional credit institutions are used to. But if the cogs of these wheels, if the PSD2 APIs and any subsequent premium APIs are not driving credit growth, okay, this will become a very minor sideshow, or this will have a very, very long gestation period because younger people and younger businesses are a long way from maturity, and CEOs of traditional credit institutions will just be quite happy to invest the bare minimum in this space. So last slide you'd be glad to know is that it's a key assumption here, but because interest income margins represent what these banks or these credit institutions are really there to do, which is take deposits and give loans, and that the reason why you only get a small reward for payments is that you're just taking operational risk, but taking deposits is liquidity risk because all the deposits can flow out in a panic, or credit risk is an enormous risk that can kill a credit institution because if only a small proportion of your borrowers don't pay you back, you're bust. Okay, so the key question around for API Day, to my mind, is the compliance element and the technology element, but how does APIs, both provision and consumption, PSD2 obligated and discretionary, how does this drive balance sheet growth in a way that's better than the way it's been driven now? That's me. Any questions?
We have time for, so it's loud. We have time for a few questions.
That was really fantastic. Thanks. I really liked how you showed the impact for agriculture and student loans and some of those areas that makes it more real for like understanding some of the benefits of open banking platforms. With that, can you go back to that slide where you showed the metrics, the ecosystem metrics? Yeah, this one. Are you seeing many, I'm not seeing many banks even starting to measure any of these. Do you see any, are any of them in play at the moment?
Very, very early days. If you're familiar with Conway's law, that says that mature organizations develop software and services that are a mirror image of their organizational structure. Their metrics are geared towards informing the head of corporate banking, informing the head of consumer banking, informing the head of small business banking, informing the head of private banking. And these measuring the Lego pieces is an absolute radical revolution in terms of how they manage their performance and project their performance.
Sorry, I've got to follow up then, because that. But when you mention Conway's law, then that's all about like how you organise, how you structure the organisation influences the outcomes or the uptake of technology and all of the rest.
Yeah.
Are you seeing, if before this comes that sort of change, are you seeing banks changing their organisational structure so they can get their heads around this mindset a bit better?
Not yet, but PSD2 is having what the impact the regulators wanted is that the procurement of API management software for PSD2 purposes gives an opportunity to actually develop premium ones or start to consume APIs, and the educational process on APIs that's coming from PSD2 is now developing a narrative around API strategy more broadly. So the catalyst that the intervention wanted is starting to fizz.
We have time for 2 more questions. Yeah, one here.
The third from the bottom there, you've got premium APIs users versus all APIs. Can you just explain what you mean by that?
I went down to once to find what a miserable chief financial officer will want to know. And I suppose there's 2 ways to get rewarded by an API: influence and payment. Okay, and it's probably a healthy discipline to make sure that a healthy proportion of the APIs that you're providing are actually generating direct revenue, because influence is great, but there's ambiguities around where that actually lands on your P&L.
So when you say premium, am I right to assume then you mean chargeable?
Yes.
That's what you mean?
Yeah.
Okay.
If we treat PSD2 APIs as the free part of a freemium charge sheet. I'm holding up Eric here now, so if there's one more.
Paul, I've got one question for you. So this is all very well to talk about the developers. It's all very well to talk about the banks. But what about the regulators? Are they really up to speed and ready for the revolution that's coming around the corner?
Well, I suppose, are they ready is a question for them to answer, but if you broaden your examination of what they're doing, it's incredibly purposeful. If you add in the Payments Accounts Directive and the interchange cap and the general data protection and the e-signatures, like there's a giant whiteboard somewhere, and they are cross-referencing and joining together these interventions. So the Euro system is designing from first principles how they think this stuff should operate. And they're definitely not using card schemes devised in the 1950s as their starting point. So whether, in terms of control, to be cynical about it, people say they can't possibly push ahead with this amount of ambiguity. And I say, well, a currency was introduced that's now in 19 countries. That was introduced with a fair bit of ambiguity. So I do think there's a determined effort here to stir the pot and from first principles. And some of the authentication requirements that are coming out of PSD2 look like they're more serving a cyber warfare, cyber security agenda than cart abandonment. So there's a real purposeful agenda. Whether they're ready to oversee it is a standard question, which I've avoided answering.
More more a cultural question I may have, but so I come from the API industry, not the banking industry. I'm discovering this industry through APIs, so it's really interesting. But outside the banking industry, we used to say like banking industry is a slow mover, fast follower. So I don't know if everybody agrees with that, but this is what I've checked. Do you think with APIs we are changing that into, I don't know, fast mover or fast mover, fast follower, or we still keep that culture?
No, I think they will keep that culture, and I think they possibly, I'm showing my background here, I think they should keep that culture. You know, and to make a trite observation, these APIs aren't distributing data on selfies. Like, it's people's money. You know what I mean? So the privacy and execution of dealing with something so important, they should be cautious. And in that context, if regulators weren't making such a determined intervention, it would be even slower. So, you know, the events of 2008 haven't made caution and prudence any less attractive in the banking industry. So, no, I think I think in this revolution and the next, they'll be the last to move, and I'd argue should be the last to move. You know, they don't want to be. They should never, given that it's people's money involved, they should never be at the bleeding edge.
Thank you, Paul. Thank you very much.
Okay, thank you.